A peace deal almost happened. And because it almost happened, crypto just lost $192 million. Sit with that for a second. Not a hack, not a regulatory crackdown, not a market crash. A canceled flight to Switzerland wiped out nearly $200 million in leveraged positions across Bitcoin, Ethereum, and XRP. Welcome back to XRP Financial Horizon. I'm glad you're here today because this story has layers, and by the end of this video, you're going to understand exactly what went down, why it hit XRP traders, and what it means for where we go from here. Background on the US-Iran situation. Let's rewind a little because the context here actually matters a lot. Over the past several weeks, there had been genuine diplomatic momentum building between the United States and Iran. Talks were progressing. There was real back and forth happening between Washington and Tehran around some kind of negotiated agreement, one that could ease Middle East tensions, stabilize energy markets, and reduce the kind of global uncertainty that tends to spook investors. Now, when news of those early talks started spreading, financial markets took notice fast, and crypto, which has become increasingly tied to global macro sentiment, moved with it. Bitcoin started climbing, traders got confident, leveraged long positions started stacking up across every major exchange. The thinking was straightforward. A more stable world means more appetite for risk assets, and crypto is definitely a risk asset. So heading into mid-June, there was this growing sense in the market that things were moving in the right direction. Prices were climbing, sentiment was improving, and traders were positioning accordingly. That optimism, as it turned out, was about to get tested in a very rough way. What actually collapsed? The follow-up meeting was supposed to happen in Switzerland. US and Iranian officials were scheduled to sit down there and continue moving the deal forward, turn the early progress into something concrete and official. Then US Vice President J.D. Vance canceled his trip. The meeting was postponed. No new date was set. And that single development, a canceled trip, was enough to flip the entire crypto market's mood on its head. Here's the thing people who don't trade crypto don't always understand. When you're in a leveraged long position, you're not just betting on the asset going up. You're betting that nothing unexpected happens to change the story. The moment the Switzerland talks fell apart, the story changed. Traders who had built up long positions expecting continued positive news suddenly found themselves on the wrong side of a very fast-moving market. And when positions start getting force closed in a leveraged environment, it doesn't happen slowly. It happens in a wave, and this wave hit hard. Voice, breaking down the $192 million. So let's get into the actual numbers because this is where the real picture comes into focus. Total liquidations across the crypto market hit over $192 million. More than $101 million of that, more than half, came from long positions. Traders who were betting on prices going up wiped out. When we look at individual assets, Ethereum actually led the damage with over $43 million in liquidations. Bitcoin came in just under that at nearly $41 million. And XRP long traders, people in this exact community, lost over $3 million in forced liquidations. Now, $3 million sounds smaller by comparison, but this is XRP we're talking about. That represents a real number of real traders who were positioned for a move up and instead got caught in the downswing. These numbers come from CoinGlass data, which tracks derivatives activity across major platforms, and the picture it painted this week was not a pretty one. The scale of this event in such a short window of time is a reminder of how fast things can move when macro news catches leveraged markets off guard. What Bitcoin's price action looked like. Bitcoin's chart this week was genuinely rough to watch. After climbing to around $67,300 on June 15th, driven by those early US-Iran deal rumors, Bitcoin started rolling over. Wednesday saw a failed attempt to push through the $66,000 resistance level, and once that attempt failed, the selling picked up. By the time things settled, Bitcoin had dropped all the way to around $62,236 before finding some temporary footing near $62,800. That's a drop of roughly 7.5% from the peak, and it happened over just a couple of days. What made it worse was the speed of that final drop. Bitcoin lost about $2,000 in price in just 2 hours at one point during Thursday's session. That's the kind of move that absolutely wrecks leveraged positions. When you're trading with 5 times or 10 times leverage, a 2% move in the wrong direction is already painful. A sudden 7% correction is account ending for a lot of traders. Bitcoin's total market cap dropped to around $1.25 trillion during that stretch, and the broader crypto market fell about 4.3%, bringing the total market cap down to roughly $2.24 trillion. That's a lot of value erased in a very short period. Voice, Ethereum's story this week. Ethereum's performance this week is worth paying attention to separately because it actually surprised a lot of people. Ethereum led all assets in terms of liquidation losses, over $43 million, edging out Bitcoin. For an asset that's often described as a utility-driven, fundamentals-backed platform, that's a notable headline. Ethereum has all the infrastructure arguments going for it: the DeFi ecosystem, the smart contract dominance, the Layer 2 growth story. But none of that shields it from a sharp macro-driven sell-off when sentiment turns fast. What this week proved is that in the short term, when fear grips the derivatives market, Ethereum trades like any other high-risk asset. The fundamentals don't disappear, but they also don't protect you if you're over-leveraged and the news cycle flips on you. Long-term Ethereum holders with no leverage probably looked at this week's drop and shrugged. Leveraged Ethereum traders had a much different experience. That gap between those two groups is one of the most important dynamics in crypto right now. XRP specifically, what happened and why it matters. For the XRP community specifically, this week brought a mixed bag. The $3 million plus in XRP liquidation stings. There's no sugarcoating that. Traders who had been building long positions in anticipation of a continued breakout got caught in the broader market flush. XRP had been in a relatively tight trading range, and a lot of traders were watching it closely for signs of a breakout. The US-Iran deal optimism had been giving those traders just enough tailwind to stay in their positions with confidence. Then the Switzerland cancellation hit, and that confidence evaporated quickly. What's worth noting for longer-term XRP holders, though, is that this kind of liquidation event is not a statement about XRP's fundamentals. Ripple's actual business, the payment corridors, the institutional partnerships, the ongoing expansion, didn't change this week. What changed was the macro environment and how traders were positioned within it. For people who hold XRP without leverage and with a longer time horizon, this week's price action is uncomfortable but not structurally damaging. For leverage traders, the lesson is expensive but clear. The market sentiment shift. Beyond the price action and liquidation numbers, what really stood out this week was how quickly overall market sentiment changed. The crypto fear and greed index moved deep into fear territory following the liquidation cascade. Bitcoin's open interest dropped 2% in a single 24-hour period, meaning a meaningful chunk of speculative positioning got closed out across the board. The derivatives market, which had been leaning bullish heading into the week, shifted toward neutral almost overnight. And when sentiment moves that fast in that direction, it tends to create its own momentum. More traders reduce exposure, more sell orders pile in, prices drop further, which triggers more fear, which triggers more selling. That feedback loop is one of the most dangerous things about leveraged crypto markets, and it's exactly what played out here. The good news is that these sentiment-driven cascades tend to be relatively short-lived when the underlying fundamentals haven't actually changed. The bad news is that they can be very painful in the moment, especially if you're carrying leverage. What traditional markets did, the interesting contrast. Here's something that's worth talking about honestly because it reveals something real about how crypto is still perceived in the broader financial world. While crypto was absorbing all this pain, traditional stock markets were actually having a decent week. The Nasdaq rose 1.71%. The S&P 500 was up 1.22%. The Dow gained 0.5%. Japanese and South Korean equity markets also moved higher. So you had this situation where the same geopolitical uncertainty that was crushing crypto was simultaneously lifting stocks. That's not a coincidence, it's a pattern. When institutional investors face uncertainty, a portion of them rotate out of higher-risk alternative assets and into more familiar, established markets. Stocks fit that description for most large funds. Crypto, despite all the progress it has made toward mainstream legitimacy, is still categorized as a high-risk alternative position by many institutional allocators. When fear spikes, they trim those positions. That capital rotation was a real factor in making crypto's drop more severe than it might have been otherwise. It's something the crypto industry has to keep reckoning with, honestly. Oil, energy, and the macro domino effect. One thing that's easy to overlook in the middle of all the crypto price drama is the role that energy markets played in this whole situation. When the US-Iran deal was first announced, oil prices dropped noticeably. West Texas Intermediate fell below $74 per barrel, and Brent crude dropped below $77. That makes sense because an Iran deal theoretically means more Iranian oil supply coming into the market, which brings prices down. Lower oil prices are broadly seen as helpful for the global economy, less inflationary pressure, more consumer spending power, and potentially more room for central banks to ease monetary policy. All of those things are generally positive for risk assets over time. But when the Switzerland follow-up talks got canceled, it threw all of that into question. If the deal doesn't hold, does Iranian oil actually come to market? Does the inflation relief actually materialize? Does the Fed actually have room to cut rates? Those questions don't have clear answers right now, and that uncertainty is sitting right on top of the crypto market, pressing prices down until something changes. The real lesson about leveraged trading. There's a real lesson in this week's events that's worth being direct about. The traders who got liquidated this week weren't all making irrational bets. A lot of them were looking at what appeared to be improving macro conditions and positioning for what seemed like a reasonable move higher. The mistake wasn't the directional view, it was the size of the leverage relative to the risk that any given news development could flip the whole picture in hours. Crypto markets in 2026 are deeply tied to macro events. US-Iran diplomacy, Fed rate decisions, oil prices, China's economy, all of it feeds into crypto sentiment now in a way that wasn't true 5 or 6 years ago. That's actually a sign of maturity in some ways, but it also means that trading crypto with heavy leverage is now essentially trading global macro with heavy leverage. That's a completely different risk profile than most retail traders sign up for when they open a derivatives account. The $192 million wipeout this week is a clear signal that position sizing and risk management need to be at the top of every trader's checklist. Voice, what analysts are watching going forward. Looking ahead, there are a few specific things that analysts and traders are keeping a close eye on in the wake of this event. On the Bitcoin technical side, key levels around $77,500 to $78,100 and $74,000 to $76,200 are being watched as important zones. Some analysts have flagged that the largest current liquidation clusters for BTC sit around $77,700 and $76,600, which means those areas could see significant price activity in either direction as the market tries to find equilibrium. For XRP, the 1.10 to 1.20 zone is being monitored as a support area that needs to hold if the near-term bullish case is going to stay valid. Ethereum has its own set of technical levels that need to hold. But honestly, beyond the charts, what matters most right now is whether the US-Iran talks get back on schedule. A new meeting date being announced could quickly reverse a lot of the bearish sentiment that built up this week. Traders are going to be watching diplomatic headlines just as closely as price charts in the days ahead. Why the long view still makes sense. Here's where I want to be real with you because I think it's the most important thing I can say today. Liquidation events like this one feel significant in the moment, and they are significant for anyone caught in them. But stepping back and looking at what's actually happened to this market over the past several years, these kinds of sudden drops driven by external shocks have happened before, and they've been followed by recovery every single time. What hasn't changed this week? Ripple is still building out its global payment infrastructure. The XRP ledger is still processing transactions. Institutional interest in digital assets continues to grow. Regulatory clarity in the US crypto space continues to improve. The ETF conversation for XRP is still developing. None of those things disappeared because a meeting in Switzerland got postponed. The macro environment is noisy right now, and it's going to stay noisy for a while. But the underlying case for XRP and for the broader crypto asset class isn't built on any one diplomatic meeting going smoothly. It's built on something a lot more durable than that. Final thoughts and wrap up. All right, so let's bring it all together. A canceled diplomatic meeting between the US and Iran triggered over $192 million in leveraged crypto liquidations. Bitcoin fell nearly 7.5% from its recent peak. Ethereum led all assets in actual liquidation losses. XRP traders got hit for over $3 million in forced position closures. Traditional markets actually moved higher during the same stretch as institutional money rotated toward equities. And now, the market is sitting in fear mode, waiting to see what happens next with the US-Iran talks, with Fed policy, and with oil prices. That's where we are. If you trade with leverage, take this week seriously as a reminder about position sizing. If you hold XRP for the long term, take a breath. The fundamentals didn't change. And if you're still trying to figure out where you stand on all of this, stick around, because this channel exists to help you work through exactly these kinds of moments with clear information and honest perspective. Thank you for spending your time here at XRP Financial Horizon. Drop a comment below. Tell me what you think about where XRP goes from here. Like the video if you found it useful, and we'll see you in the next one.